dynamic bond fund and the government bond fund investment plan are both active duration products, continue to be active duration products. For the last more than 1 year, we have liked long duration government bonds, and these funds continue to be extremely overweight long duration government bonds. Just to briefly recap reasons for this overweight. So first of all, we do think India bonds are facing or benefiting from a bit of a structural tailwind. This is on the back of a current account deficit trajectory which has now been reset from what used to be 2.5–3% earlier to now 1–1.5% of GDP. Continued commitment of the government of India to fiscal consolidation, that is capping total bond supply and also improving perception of India bond markets in the eyes of global investors, and a very credible RBI monetary policy framework that continues to emphasize inflation targeting. We think at less than 3% of total outstanding, FPI ownership of India government bonds continues to be very low, and we fully expect this to rise substantially over the next 3 to 4 years, thereby creating one additional source of government bond demand. Unlike previous cycles where there has been propensity to treat the interest rate market as very tactical, that is, investors tend to position into bonds on the brink of a rate cut and then try to exit soon after. We think this time around it makes much more sense to treat bonds more from an asset allocation perspective, given that some of the tailwinds we are facing are actually medium term, which the bonds are benefiting from, like I just explained. Turning, however, to more shorter term factors, those are also reasonably bullish for Indian bonds. So the RBI has started the rate cut cycle. We expect 50 basis points more over the course of the next 6 to 12 months. It is also infusing liquidity, including via open market bond purchases. That is also creating additional demand for duration in the market. The only source of volatility for the time being has been the volatility we are importing from abroad, chiefly the US market. However, lately we have seen some calming down of the US dollar as well as US interest rates, and if that continues, that should benefit flows into India bonds as well. In the last 2 to 3 months, there has been some underperformance of the long end of the government bond curve as 30-year to 10-year spreads have widened. However, we expect this to settle down as there is enough room for government to tweak the auction calendar should enough demand not surface for the long end of the curve. However, we expect this is one of the best macroeconomic trades that you could think about in India, given the next 2 to 3 years of investment horizons, because if you continue to be bullish bonds, it makes sense to hold longer duration for absolute higher price performance, even if there is some widening of spread versus short-term bonds. So we reiterate our preference for long duration bonds in these products.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.